Welcome back. You're watching Editors Roundtable, and we're putting the spotlight now on the technology names. The question that we're asking is, can IT emerge as the dark horse? Is there a possibility that IT can positively surprise in the second half of this fiscal year or next year? So to put it in context first, Q4 was a howler. Expectations for the first half of the year, that's Q1 and Q2, have been completely erased. Everyone's expecting a muted quarter. But companies held out hope that in the second half of the year, things will recover. But there were many bears on the street who believed that the second half of the year recovery is not going to take place. But here we're putting out some data which may belie that expectation. The US economy is still firing. Look at all the data points that have come through, whether it's the labor market data, the fact that consumer confidence is at the highest level since January of last year, the Q1 GDP print coming in 2%, getting revised higher compared to their earlier estimate, the fact that all 23 big US banks passed the stress test. So if the US economy is indeed quite strong and resilient, and expectations of a recession have been pushed forward now to next year, then can the US sentiment turn? And if that turns, will they start spending? If you remember what Rajesh Gopinathan, the outgoing CEO of TCS, had to tell us in April, he said, and I quote, US reacts fast on the downside as well as on the upside. If the current uncertainty goes away, we can expect a significant pop at year end. Bear in mind that the first half, Q1, is going to be very muted because all channel checks seem to suggest that, at least as of now, client decision making has not picked up. The projects which were put on hold continue to be put on hold. They've not restarted as of now. So Q1 is going to be weak. The question that we're asking is about H2, the possibility that FY25 turns out to be a very strong year. IT stocks consequently have also rebounded a fair bit. So the low that all the IT stocks hit was when Infy came out with their numbers on 17th of April. And since then, across the board, there has been a rally of 17 to 17%. Valuations right now are not very expensive. The IT sector is trading at similar or slight discount valuations to their 5-year rolling average. And even the relative valuation, TCS, for instance, is now trading at a discount to Accenture, where up until now it was trading at a slight premium. So just let me put this, this is the data point that I wanted to throw up. Do you think there is a possibility that IT could turn out to be the dark horse? Because street expectations are quite low. But do you think it can positively surprise?
Well, thank you, Rima. I think you captured a lot of the data very well. What I would say is this year is, 6 months is a long time in these, when it comes to IT sector. But this year, the spending environment, and also very important caveat, the stocks would behave quite differently and well ahead of spending rebound. So the stocks started declining late 21. Whereas the fundamentals or the order flows and revenue growth and all remained robust till the end of 22. So the IT companies only started seeing softness in demand 12 months after the stocks signaled demand slowdown. So it is possible, very possible, that the stocks now rebound and rally 12 months ahead of recovery in actual demand environment. But if we keep the stock price performance aside, if we look at the fundamentals, I think the demand environment as things stand today looks a little difficult that it would rebound in second half in any manner, any material manner. The first half they've all orchestrated would be a weak demand environment. Second half is more hope than expectation, founded in any tangible evidence or data. So we are, as a team, expecting this full fiscal year to remain soft. And obviously, 12 months out, it's too difficult to tell when it's going to turn. But turn It is going to be at some point in the near future. Sorry, back to you.
Okay, we'll leave the discussion here. Thank you very much for joining in. We've got one more piece that Anuj would like to present. And Anuj, now the big question is, where will the leadership come from? Is it going to be banks or is it going to be IT? Because in the domestic sector, it's these two. In the Indian markets, it's these two sectors which have the highest weight.
Yeah, you know what? And what's fascinating is that if you look at a long-term period, it doesn't matter actually, because both have done equally well. Let me just explain. And this is a study which, I'm giving credit to Motilal Oswal, because they have done the number crunching. Very interesting data points here. Now let's go through what's happened. This is the alpha creation study. Where do you see alpha being generated from here on? Now let's talk about calendar year 2022 first, which is where the bank Nifty outperformed. Remember, last year was very tough for IT companies. There was a big divergence. Bank Nifty outperformed by about 47% compared to Nifty IT. Then in the first half of this year, the Nifty IT outperformed and it had 14% divergence as of February. But after the shocker from Infosys and you had that decline, IT stocks nosedived and there was another reversal in the April to June period, and which meant that this positive divergence for IT was down to 2% by June 2023. Now, what's very interesting is if you look at what these sectors have done in terms of their earnings growth and in terms of where the prices have moved. Now, this is Nifty Bank. By Nifty Bank, I mean all components of Nifty Bank and as an aggregate. The EPS compounded annual growth rate over the 10-year period, remember 10-year period, has been 14% and the stocks have mirrored that. The price return has been 13%. Actually, it's slightly lower than the EPS CAGR. On the other hand, the Nifty IT's EPS has gone up only 11% compounded, but the stocks have returned 17%. What does that mean? That the Nifty IT valuations have obviously gone up. Now, if you want to talk about the recent data, which is fascinating, you look at, for example, the last 3 years, the bank earnings have compounded 40% and the stocks have compounded at 34%. The stocks have won 34% return. IT, on the other hand, has gone up only 10% despite that post-COVID period. That included, the CAGR has been only 10%, but the stocks have gone up 37%, and this is where that big balloon of valuations happened in the IT stocks 2 years back. And this is just for the year FY23. The Nifty Bank's EPS growth was 38% and the price return was 21%. And this is where the reality kicked in. Nifty IT 7% EPS growth and price move of about 26% on the downside. Now, this is all in the rear view, right? What happens from here on? What Motilal Oswal expects from here on, earnings CAGR over the next 2 years. Again, Nifty Bank to outperform Nifty IT. 20% in Nifty Bank versus only 14% in Nifty IT. That's going to be interesting. Now, last but not the least, the valuation picture. What was fascinating was all through FY13 to 19, banks led the Indian market. And then we had the 19 to 23 period in which the IT took over the leadership. And what is very interesting is that over the last 1 year, if you look at the valuations, IT is still trading at a premium. In fact, banks even now are trading at 30% discount to long-term average, and IT is trading at 9% premium to the long-term average. I mean, it tells you that logically, perhaps the bank should do even better from here on. IT, of course, could still do better or could still do well, but the sense I get is that over the next 4 or 5 years, it's perhaps the banking stocks which could be in for more re-rating compared to the IT.
Okay, Anuj, very interesting analysis over there. We're going to wrap up on this edition of Editors Roundtable. We'll also once again thank Prashant Khemka for joining in. Enjoy your weekend.